When you cross the threshold into the maturity phase of your financial life, everything changes. The mental models that served you for decades, the strategies that worked brilliantly in your 30s, 40s, and 50s, can suddenly become the very things that destroy your security. There is a specific point in every investor's life where the game shifts from accumulation to preservation. Earlier in life, your greatest asset was time. You had the luxury of a long horizon, which acted as a shield against volatility. If the market crashed, you simply waited. You had decades of future paychecks to absorb the blow. But as you enter the final stretch toward full financial independence, that shield dissolves. When your time horizon shortens, the recovery periods that once seemed manageable become impossible. You are no longer investing for the person you will be in 30 years. You are investing for the person you are today. I have spent decades watching this exact pattern repeat itself across every market cycle. I see successful professionals who were brilliant investors throughout their working lives catastrophic mistakes at the finish line because they refuse to adjust their approach. They suffer from recency bias, thinking that, because risk-taking worked for them in the past, it must be the right path for the future. They hold on to volatile stocks that crash at exactly the wrong moment when they need to start making withdrawals. They chase high yields in murky, risky investments because they are afraid of inflation. They put their trust in advisors who prioritize commission-heavy products over actual safety, and they pay for these mistakes with their freedom, their peace of mind, and their ability to leave a legacy for the next generation. Today, I am going to share with you a blueprint consisting of the only 3 asset classes mathematically safe for this mature stage of life. Not investments that might be safe or probably are safe. I am talking about tools designed for one purpose: to protect every dollar you have spent a lifetime building. Redefining the word safe. Before we look at the specific tools, we have to get honest about the word safe. This word is misused and abused constantly in the financial world. Salespeople throw it around to close deals. They call high-yield corporate bonds safe because they pay interest. They call complex annuities safe because they have an insurance label. They call dividend stocks safe because they generate cash flow. But none of these are truly safe in the context of wealth preservation. For a mature portfolio, true safety is a 3-part test. First, it means impenetrable principle. Your core capital must be protected regardless of what happens in the markets or the global economy. Second, it means reliable yield. You must receive the income you were promised without fail, no dividend cuts and suspense, no surprises. Third, it means immediate access. Liquidity is life. You must be able to access your money without penalties or waiting for a settlement that takes weeks. Most investments fail at least one of these. Corporate bonds lose value when rates rise. Dividend stocks are still stocks. They can drop 50% in a recession. Annuities often lock your money away behind surrender charges. The universe of truly safe investments is much smaller than Wall Street wants you to believe. The price of volatility. A case study. Let's illustrate why this matters with a case study of an investor named Harold. He reached the end of his career with a $2.3 million nest egg. He thought he was set for life. His advisor, using a traditional model, kept him in 60% equities, arguing he needed growth to outpace inflation. Then came a major market correction. Harold watched 40% of his life's work evaporate in months. At this stage of life, that kind of drop isn't just a number on a screen. It's a psychological trauma. Harold panicked. He sold egg at the bottom to save what was left. He missed the entire recovery that followed. He spent the rest of his life in a state of constant financial anxiety, skipping family gatherings and cutting back on every small joy because he was terrified of running out of money. Harold's story isn't rare. It happens every time a growth strategy is mistaken for a stability strategy. I've seen thousands of similar stories, people who did everything right for 40 years. Only to fall apart because they took risks they no longer needed to take. They chose the potential for more over the certainty of enough, and the market punished them for it. Pillar 1. The ultimate foundation. The first pillar of a mature portfolio is short-term United States securities. Specifically, I am talking about Treasury bills in 1 year or less and notes between 3 years. These are the safest investments in the world, period. Why? Because when you buy a Treasury, you are lending directly to the U.S. government. They have the power to tax and the power to print currency. There is no historical scenario where they default. Through the Great Depression, World Wars, and every financial crisis of the last 2 centuries, Treasury holders have been paid in full on time. Some worry about national debt, but that is a purchasing power concern and inflation concern, not a default concern. And for short-term Treasuries, inflation risk is minimal because you are only lending your money for months, not decades. The beauty of short-term is that it eliminates interest rate risk. If you buy a 30-year bond and rates rise, your bond price crashes. We saw this in 2022 when long-term bonds lost over 80%. That is not safe. But a 6-month Treasury bill barely moves in price regardless of what the Fed does. Currently, with yields in the 4 to 5% range, the opportunity is extraordinary. For a person with $1 million portfolio, that is $40,000 to $50,000 in annual income with zero risk to principal. I recommend allocating at least 50 to 60% of a mature portfolio here. It is your rock-solid foundation. You can buy them through Treasury Direct via simple, low-cost ETFs like Shire Bill. It is clean, fee-free, and transparent. Pillar 2. Longevity engine. The second pillar is a low-cost F500 index fund. Now I know what you're thinking. Stocks are volatile. How can they be safe? The answer lies in your timeline. While you shouldn't put money in stocks that you need in the next 3 years, have a portion of your wealth that won't be touched for a decade or more. For that specific portion, the S&P 500 is the most reliable tool in history. Over any 20-year period, the American stock market has never failed to produce a positive return. By using an index fund, you eliminate idiosyncratic risk, the risk of one company going bust. You aren't betting on a single CEO, you are betting on the 500 largest engines of the American economy. Individual giants like Enron or Lehman Brothers can go to zero, but the S&P 500 cannot because it is self-cleansing. It automatically removes the losers and replaces them with the winners. I recommend 20 to 30% here. This is your longevity layer. Acts as a hedge against inflation and ensures that your purchasing power grows over the long term. But, and this is a critical but, this only works if you have the temperament to hold the noise. If you know you will panic and sell during a 20% correction, then this allocation is too high for you. Be honest with your own psychology. Pillar 3. The buffer of freedom. The third pillar is cash in FDIC accounts or Treasury money market funds. This is the simplest tool, yet it's the one advisors often tell you to avoid because it doesn't grow. In a mature portfolio, cash isn't for growth. Cash is for peace of mind. It is your emergency fund, your medical reserve, and your psychological buffer. When you know you have 1 to 2 years of living expenses in a liquid account, care what the market does. You can wait out any storm because your immediate needs are covered. The liquidity that cash provides is invaluable because life is unpredictable. Whether it's a home repair or a family member in need, having dry powder allows you to handle life's surprises without selling your other investments at a bad time. Currently, high-yield savings accounts are paying 4 to 5%, meaning your idle cash is finally working for you. Keep at least 12 months of spending here. It is the price you pay for never having to worry about the headlines. The philosophy of enough. When you combine these 3 short-term treasuries for income, an index fund for growth and cash for liquidity, you have a resilient ecosystem. Let's look at a $1 million example. $550,000 in treasuries, generating $25,000 a year. $300,000 in an index fund, providing long-term upside. $150,000 in cash, covering over 2 years of expenses. This isn't about getting rich. It's about staying rich. The financial industry wants you to be afraid of missing out. It wants you to believe that you need complexity to succeed. But the happiest people I know in their financial maturity are not those with the most complicated portfolios. They are the ones with the least worry. They have achieved financial peace, which is far more valuable than financial maximum. You have already done the hard part. You built the capital. Now your job is to protect it. Stop swinging for the fences and start focusing on the certainty of enough. Use these 3 time-tested tools to secure your future. Simplify your finances, reduce your stress, and spend your time on what actually matters: your family, your passions, and the life you have worked so hard to earn. Your money is safe. Your future is secure. Go live it.